For most, trading stocks represents a way to financial freedom. And there's one magic word they all know: diversification. One of the biggest lessons that most people understand is that as you diversify, you lower risk, which in turn is good. But here's the part most forget. With lower risk also comes lower reward. Take a look at Berkshire Hathaway and Warren Buffett. At certain times, Apple stock alone represented over 50% of their entire portfolio. Some called it risky, but Warren Buffett knew the business inside and out, and therefore was confident in its ability for gains. In response to these positive signals, he de-diversified, which kept his gains undiluted and vastly increased the company's net worth. Diversification is only useful for those who need lower risk or do not have the time to understand businesses as a whole. If you understand the companies you hold inside and out and understand their risk, de-diversification could be your best friend. One key note, however: de-diversification is only a good choice if you are invested in safe companies. Take Nvidia. Most would de-diversify, but the truth is they carry massive revenue risk and can swing wildly. Not all investments are good de-diversification plays. In the world of individual stock picking, many use technical analysis or other methods of trading that operate on small timeframes from hours to weeks. The truth is, they run a massive risk that isn't talked about often. A good rule of thumb is the shorter the trade, the more outside factors affect it. Because of unpredictable factors like presidential tweets or bearish company news, trades based on technical analysis or short timeframe indicators are at the mercy of their performance being instantly tanked by one negative event. In contrast, long-term trades over years or decades minimize this risk, as over time, these one-time events are swallowed by long-term gains. 99% of the time, a losing trade can be traced back to one thing: ego. Firstly, many are convinced that they know more than the rest, and therefore that they have a winning strategy. In reality, they couldn't be further off. The truth is, individual stock picking is so hard because there are dozens of different factors that affect performance. So, how can you minimize this risk while maximizing potential reward? The answer is sector-wide ETFs. Concentrating on one stock is all well and good when you're an expert, but don't pretend to be if you're not. If you know that clean energy is the future, but deep down don't really understand the individual companies you're invested in, go for a clean energy ETF. You minimize your risk of a massive loss due to fraud, bad earnings, or poor management, while still aiming for above-market returns due to your concentration in a winning sector. Sectors are much easier to understand than individual companies. They carry none of the complicated and murky company financials and documents that individual stocks do, and are often more resilient to change. One of the things that many individual stock pickers learn very early in their trading journey is that everyone on Wall Street has a different opinion on the stocks you hold. It can be on Reddit, the news, an article, or just on social media, and they're all different. Some say the stock will rocket up. Others say it will go crashing down. Others still might say the price will move sideways. The important thing to realize is this: on average, 47% of all analyst predictions are wrong. If you buy into an individual stock, don't let the opinions of others, even if they're so-called experts, sway you, because there's a high chance they're completely wrong. When you read the news about your stocks and see analyst articles on a buy or a sell, read them and take a note at the key points, but take the results with a grain of salt.